Hello and welcome back. In this video, we are going to discuss about the various steps involved in profit and loss analysis of the room division as a whole. So we're going to look at a step-by-step approach, and then I will explain the steps in one by one in the next video. So the first thing we supposed to do is the export into Excel. So because it makes it easier to calculate the formulas and calculate the variances in Excel. So if your profit and loss is not in Excel, either you can type it out or you can ask your department or finance department to export it into Excel and give it to you, so that it's much easier for you to calculate the variances or calculate the percentages. So and it makes it easier for you to review the P&L. The second step is to calculate the variance columns, because some of the standard ERP softwares or the hotel management software, they don't give the variance analysis. They just give only the room actual budget and last year column. There is no variance column from this year versus budget, this year versus last year. So if they are not there already, you should calculate it, because it comes very handy when you are analyzing the profit and loss statement. So this is why the exporting into Excel is very important. Then you have to calculate the GOP flow through, because this is another important aspect of managing the profitability of department. You must maintain the flow through of the profits compared to the revenue shortage or excess. If revenue is high, however, the profit is not enough, has not increased enough, then it's a bad news, because maybe you are not managing the expenses. So these things we will look at into the next videos. Then after that, you need to ascertain what is the variance in the overall revenue. Is it favorable or unfavorable? Because the further review of the expenses will also depend on this variance. Is it favorable or not favorable? So let's say if the room revenue is not favorable, is negative, what you're going to do? So you're going to do is identify all segments which are negative. Then you have to identify all expenses which in terms of percentage are lower than the room variance, because the logic is that expenses should be controlled if the revenue drops. So if the revenue is dropping by, let's say, 10%, the expense should drop either by 10% or more than that. If it's not, then it will affect your profitability. And then you need to get the details from the general ledger of what are those expenses, so that you can control, you can analyze them in more detail. Let's say if the revenue is positive, then even then you need to see, is there any segment, individual segment which is negative, because maybe overall revenue is positive, however certain segments can be negative. But if that segment which is negative is high yield, means they are commanding the higher rate, then it means that reducing the business from the high yield business, giving and getting more low rate business, even though revenue may increase, but it will increase the cost of doing the business as well. So it may impact the profitability. So here again, after you have done this, you need to calculate the expenses if there is any expense which is increasing more than the revenue increase in terms of percentage. So we're going to look at the steps one by one. So we're going to be doing two phases: step 1, 2, 3 in one video, and then step 3, 4 to 6 in another. Stay tuned. Thank you.